Now, after that meeting ended of the FOMC, that ended 14th of December, it took place over 2 days, 13th and 14th December. After that, the US Central Bank, the Fed, published new projections which showed that they were expecting the inflation to be higher than they previously thought by the end of 2023. And the reason behind this thought is going to be out. It's going to be out when the Fed reports the minutes of that meeting. It's going to happen later tonight, and of course, it's going to happen in Washington. The record is also going to give a hint on the duration, how long the Fed is going to stay at peak interest rates, and if there could be any signs of reduction of interest rates in 2023. Of course, even as we speak about the Fed stance, we are also considering how gold prices are moving. Gold is just shy of its all-time record high levels when it comes to their prices. What do these developments mean for investors? We're going to discuss that with our guest tonight. But first, here's a brief report on gold prices, how they've been moving, and the chief factors that's helping move these gold prices higher. Sharad is here to tell us exactly that. Sharad.
Yes, gold is shining pretty much across all asset classes, and we can see it's the MCX gold spot rates. They are almost near the 2.5-year highs, and they are closing in on the rupees 56,000 per 10 gram mark. And this is pretty important, and important development coming in is that in August 2020 itself, we see their lifetime high levels were there. The record was set at almost 56,191 rupees per 10 gram. But now let's look at the movement, what has happened. And from September lows itself, if you see the MCX gold spot returns, that has come in almost 13% up as well. And if we see the 1-year returns, that is also coming in at almost 16%. Now this is outperforming most of the asset classes, while Nifty also rose almost, you can say, 4.5% over the last 1-year basis. And even the international gold prices, they were also on a tear, seeing from the September lows as well. But let's look at the important reasons. What are the important triggers for the gold for 2023 and why it can sparkle, as what analysts and experts are estimating? Now there is a fear amongst investors, and during this time you can see they are trying to go for a safe haven amidst the market volatility which have been seen. Now because of this, there is a value erosion happening across financial assets. Take Bitcoin, take interest rate sensitive sectors such as the IT sector, where market cap erosion is happening across the listed space. That's another reason coming in is the FOMC rates hike, which is in the final stage as well. Now, from this point, we move to the important point being the central banks. They are increasing their purchase of gold. And lastly, the most important point is a strong investment demand is coming, especially in the domestic Indian markets. And apart from this, the marriage season is here, and even the jewelry demand has picked up, as we can say, updates coming in from Titan and other jewelry stocks as well. But the entire crux is being fear. Now, fear comes for the investors, even for institutions and other assets where we are deploying apart from gold.
All right, so that's the kind of outlook and what we have going on so far with the prices of gold. Let's get further perspective from the experts who are joining us. G Chandrashekhar is with us. He's a commodity market specialist, and along with him we have Priya Misra as well, the head of global rate strategy over at TD Securities. Thanks for joining us both. Do tell us, as far as your assessment goes, Priya, of gold demand in India right now, how do you see that panning out in 2023? Do you see Indians continuing to buy a lot of gold this year? Because right now we're seeing these prices in India, as far as gold is concerned, at those elevated levels, at the highest levels.
So I might reserve comment on gold, big fan of the metal myself. But, I think from a macro standpoint, one of the reasons for that demand is fear of recession. And from a macro standpoint, look at interest rates globally are pricing in this risk of a recession, later this year, probably even as early as the middle of this year. So I think if that fear continues to grow, I think the demand for safe haven assets will be there. You look at what's happening to government bonds. There's a significant demand. At the start of the year itself, we've had a 30 basis point decline in the German 10-year. We've had a 25 basis point decline in the US 10-year. All of this is suggesting that demand for safe haven assets, because all central banks here are sort of catching up to inflation, there's a big concern that inflation may be sticky on the way down. And so does that mean that the Fed, for example, might hike to 5.5? The market's pricing in less than 5. If they're going to keep hiking, that makes a slowdown more likely. So I think, it might still come back down to, from a macro standpoint, inflation, how sticky that is. Where do these central banks end? And does that sort of sow the seeds of a global recession, global slowdown, which can keep the demand for safe havens alive? That's essentially what I'm looking at from a macro standpoint when I think about gold. But I'll pass on to the experts for specific gold demand.
Absolutely. Mr. Chandrasekhar, we are coming to you for that. What's the kind of volatility that you're expecting in equity markets? Because that perhaps is going to draw investors towards gold going ahead from here, and hence we are likely to see a further spike in gold prices. What's your reading, Mr. Chandrasekhar?
Are you asking me?
Yes, sir.
Yes?
Yes, Mr. Chandrasekhar. Please
Okay,
go ahead.
right. Yeah. Oh, that's right. Thank you very much. I certainly expect a lot of volatility in the equities market. There is no doubt at all. There are 2 or 3 factors that are going to play out. I strongly believe the US Fed is not done with the interest rate hikes. In the first quarter, there'll be at least 2 rate hikes of 50 basis point is my expectation. The one that's coming soon is on the 31st of January, 1st February, that meeting of the Fed. The second could be in the month of March. And these 2 rate hikes are very widely expected, which I think will lend a certain will actually strengthen the dollar and also help raise the bond yields, and that can potentially become a headwind for gold in the short term, that is in this quarter. But sticking to gold again, in the second half of the year, I'm reasonably bullish on gold, and I expect gold to certainly breach $1,900 an ounce, primarily because of recession fears, primarily because there will be a rate pause by the Fed, and the dollar will weaken, and that is what is going to propel gold higher, probably $1,900 an ounce and a little more. Therefore, I see this year as 2023 as a year of two halves. In the first half, gold will, in my view, continue to be under pressure, notwithstanding the current spurt of about $50 or $60 because of a very temporary weakness in the dollar and safe haven buying by certain institutions. From an Indian perspective, let me assure you, prices above 50,000 rupees for 10 grams would actually lead to certain demand destruction. Indian market is a highly price sensitive market, and the high prices drive consumers away. The only purchase by consumers would be, for example, weddings. And because that's a tradition in our country to buy gold during the wedding. But
yes, that's always an exception. Yes, you're right.
Buy on a budget, which means the volume.
So you're seeing some destruction of demand when it comes to gold. But that's in the Indian context. Right now, Priya, also market participants everywhere around the world very keenly focus on the monetary policy stance of their countries. And the major central bankers, they have been doing a lot of gold buying as well. So a move in dollar index and yields, they're very keenly watched by the market. It's going to determine the course of gold prices. What do you see as the Fed stance now? Because, of course, as we wait for the minutes of the FOMC's last meeting, we're wondering, like Mr. Chandrasekhar was also alluding, whether we've peaked out on these interest rates, whether it's happening all too soon, because at one point in time, we are looking at around March and 5.5%. But where do you think the Fed is right now on those interest rate hikes?
Sure. And the dot plot in December actually was a pretty big revision in terms of where the Fed sees peak Fed funds of, 5.125. We actually think that they're going to revise it higher again. And it all comes down to how quickly does inflation decline. I mean, our view is CPI from 7% to 4% will be a relatively quick decline. The Fed's target is 2%, and we don't think we're looking at 2% at all this year. So our view is that in March, when the Fed comes out with this next set of projections, that they'll move that higher again. Maybe not as much, up from 5.1 to 5.5. That's where we think that endpoint of the hiking cycle will be. I think the question for today's minutes is, how do they talk about tolerance around inflation and the unemployment rate. Because in December, what they told us is that they expect the unemployment rate to rise. And how confident are they that they will not be nervous about hiking if the unemployment rate is rising? What's the level of inflation that they're willing to tolerate above 2%? I think we'll be watching for that. I also think the market's going to be focused on the base. For that February meeting, do they hike 25 or 50? If they're signaling 50, I think the market's going to get nervous that there's a lot more hikes, because then you get to 5% in one meeting. Then 5.5, maybe higher than 5.5 is possible. Or do they downshift again? I think that pace of hikes, as much as Chair Powell tries to tell us that the pace, we should divorce the pace from the endpoint, the market sees the two as very linked. If they are slowing down the pace of hikes, I think the market's going to say maybe the end of the hiking cycle is in March. I think they're going 50 in February. They may go another 50 in March or downshift at that point. So we think, it's around 5.5, and all will come down to we get a CPI report next week. I think that's going to be a big focus point, because inflation has peaked. How quickly is it declining? I think that's going to be the focus for this year. And I agree, it's going to be volatile, but we think the Fed is not done. They are nervous that they stop and then inflation restarts or settles down above 2%. I think that's their nightmare scenario.
Fair enough. So just to put this in context, what Priya is telling us, Mr. Chandrashekhar, gold is, of course, considered a hedge against inflation and all the economic uncertainties that rule our world today. But higher interest rates increase the opportunity cost of holding gold, because gold doesn't pay interest. Why then are we seeing rising demand for gold in a rising interest rate regime, at least how it is right now in most parts of the world?
No, primarily gold will now, because of recession fears, also act as a safe haven asset. And that's what is going to drive gold prices higher, which in my view, there is a strong case for gold to rise. But as I said, that's going to happen in the second half of the year. At the moment, gold has got a lift of $40 or $50, which I think gold will essentially correct by the end of this month, when the next meeting takes place, and certainly in March once again, when the second hike is expected. And therefore, this spurt at the moment, in my view, is temporary. And the correction is certainly going to set in.
That's what you mentioned.
Which is what I believe. Although
yes.
I don't trade, let me make it very clear.
No, fair
Disclaimer, I don't hold any position. But in the second half of the year, dollar will weaken, bond yields will be lower, and that is what is going to give a lift to gold.
So looking at the trajectory of the Fed's interest rate hikes, how are gold prices going to react to the Fed's decisions in the next couple of months? Mr. Chandrashekhar.
Yes, obviously, if much will depend later tonight for India, past the midnight, what the minutes of the FOMC are going to say, and what is the forward guidance that's going to be available. But I believe the Fed will continue to do everything within its capacity to contain inflation. And at the moment, at least, the signals that we get is that it still has some way to go before it can really claim to have controlled inflation. And therefore, that's going to become a headwind for gold in this quarter. Again, let me repeat, notwithstanding the current spurt of $50, $60 in gold, there will be correction.
Yes, you made that
amply clear. What will happen
clear
in the second half of the year?
Yes.
I think to me, it's very, very clear. Weakening dollar, lower bond yields will actually lift gold. Recession will start to further threaten the global economy, and therefore there'll be a flight to safety.
Right. Priya, in that context, do you see central banks increasing their purchase of gold going ahead now?
So I would say a lot of developed market central banks don't buy gold, like, you're talking about the ECB or the Fed. I think when we talk about emerging market central banks, I do think that gold is a diversifier asset, particularly if the dollar is starting to weaken. I think much will depend on how much the dollar weakens. Is the Fed starting to cut rates at the end of the year? I think there is a value of gold as a diversifier aspect of central bank reserves. I think that demand remains, but the extent of that demand, I think, will depend on, how is the dollar reacting to this? If it's a global slowdown, the dollar doesn't weaken as much. I think US assets might be, particularly government bonds, might be considered more attractive. But fundamentally, I think, yes, that demand should remain there.
What are your projections for the US dollar now? Priya?
We are in the near term, we're actually positive the dollar because we think the Fed's going to hike more than what is priced in. I think just because inflation seems to have peaked, I think the markets become overly optimistic that it's going to continue to decline. Inflation has shifted in the US from goods inflation to service inflation. Service inflation is notoriously sticky because it's driven by wages, and the labor market's still very tight. So I think the market's underestimating how much the Fed will hike. So we're actually positive on the dollar in the near term. Once the US heads into a recession, which is our base case in the second half of the year, that's when we start to turn more negative on the dollar. But it's always tough with the dollar. What do you buy against it? Because it's not as if Europe is necessarily strengthening. So I think the downside is limited, but we do see downside into the end of the year.
Mr. Chandrasekhar, before we let you go, just wanted to understand from an investment perspective, because perhaps in these volatile times, we're looking for less riskier assets. So in your scheme of helping investors decide which asset classes to park their hard-earned money in, what are you suggesting?
If I may mention, I would actually put my money on silver rather than on gold, because I'm absolutely bullish on silver because it's not only a precious metal, it is also an industrial metal. And given the fact of electrification, 5G technology, energy transition, etc., there's going to be a massive increase in demand for silver. The silver market is in actually a state of deficit to the extent of 6,000 tons. But silver prices would rise anything between 10 and 15% this year. I may not be able to say the same thing about gold.
All right, fair enough. A lot is in play right now, and we are watching what happens on all these factors. We are also going to be seeing how Wall Street really reacts to the minutes of the last FOMC meeting that takes place. But Priya and Mr. Chandrasekhar, always a pleasure talking to you and getting your perspective on the markets as it develops.